We are living in a golden age of retail trading. Anyone with a smartphone can now access the kind of real-time order flow, algorithmic strategies, and charting tools that used to cost Wall Street firms millions of dollars to maintain. Yet, despite all this technological firepower, the math hasn't changed. The vast majority of everyday traders consistently lose their money, acting as a conveyor belt that funnels wealth straight into the pockets of a tiny, elite minority. Mark Douglas, author of The Disciplined Trader, attributes 80% of success to psychology, leaving only 20% to the actual methodology. In his view, a trader's mental state dictates profit more than the mathematical model they use. This raises a strange question. Why does the simple, mechanical act of clicking buy or sell trigger such devastating failure in otherwise highly intelligent, highly successful people? The answer starts long before you ever open a brokerage account. From childhood, our brains are deeply conditioned by a highly structured society, an environment specifically designed to reward certain behaviors and protect us from harm. In everyday life, we learn a very predictable equation for success. We believe that time and physical effort directly correlate to financial reward. You put in the hours, you do the hard work, and you receive a paycheck. At the same time, we operate within strict external boundaries. Laws, managers, and social norms all exist as guardrails to prevent us from making catastrophic, life-ruining mistakes. Subconsciously, we carry this conditioning straight into the trading environment. We sit at our desks expecting the market to reward our intense study and protect us with familiar boundaries. But the market is an entirely alien ecosystem. It is completely unstructured, existing in perpetual motion with no defined beginning, no ending, and no inherent rules. In this environment, the effort-reward equation completely falls apart. A trader can make a massive windfall in 30 seconds with zero physical effort, or they can lose an entire year's salary just as fast. And there are no managers or guardrails here. The market has absolutely no power or control over your behavior, meaning there is an unlimited, constant potential for ruin. When you try to navigate an environment of infinite freedom and zero external constraints using habits built for a rigid society, the result is almost always financial disaster. This disconnect peaks the moment a trade moves against you. Suddenly facing a loss, the brain panics, triggering the exact same societal defense mechanisms we use to avoid emotional pain in everyday life. This leads to a phenomenon Mark Douglas calls perceptual distortion. Your mind will literally start altering or selectively ignoring market data, hiding information that confirms you are wrong in order to protect you from the pain of a loss. Eventually, the reality of the loss becomes too large to ignore. You hit a state of forced awareness, where the market brutally forces you to confront your illusions, resulting in a state of shock and deep psychological damage. This damage generates a pervasive fear, which paralyzes your decision-making. It causes you to revenge trade to win back losses, lock yourself into stubborn opinions, and flat-out refuse to define a stop-loss. When an account drops to zero, the trader hasn't actually lost to the market. They've lost to their own culturally learned behaviors breaking down. To survive this, the elite 10% of profitable traders have to actively unlearn their societal instincts. They perform what Douglas refers to as a thorough mental housecleaning. They achieve a critical shift in perspective, stripping away all the emotional weight and societal guilt tied to losing money. A loss stops being a personal failure and becomes nothing more than objective business feedback. Because the market provides zero structure, the successful trader realizes their ultimate task is to build a rigorous, artificial structure to govern their own behavior. Journaling and analytics platforms provide the foundational architecture for this self-imposed structure. By automatically syncing trades and visualizing raw performance data, these tools act as an objective mirror. They force you out of perceptual distortion and ground you back in mathematical reality. When you use tick-by-tick replays and tag your specific setups, you are gathering hard evidence to prove to your own mind what actually works. You slowly replace hesitation and self-doubt with cold self-trust. Consistency requires taking total accountability for every decision. By anchoring behavior in objective data, a trader replaces emotional impulses with cold, calculated execution.